Welcome to the Supplemental Charts video, where I'll go over some interesting charts, mostly from isabelnet.com, as well as some other charts that I found during the last week, and this will cover February 13th through February 17th. First, we look at sectors, where we're looking at the energy sector. This is a weekly chart, and it's relative to the S&P 500, where energy has really been underperforming until the beginning of 2022 when energy really took over, and it's still in an uptrend. And this chart is predicting that we're seeing some nice gains. We'll see a bit of a pullback with lots of support, and then finally end up going even higher. Looking at sentiment, this pretty much matches up with the sentiment index that we use. This takes the AAII, the Investors Intelligence Bullish Percent Index, the put-call ratio, the Active Asset Manager Survey, and the VIX, and puts them together. And currently we're not extreme positive, but we are positive. We had tipped over a little bit into extreme greed territory, and that often suggests at least a short-term top, where we're coming back down currently. The chart just shows this index and its current readings compared with the S&P 500 over top, and that is in black. Another thing that we look at, and I did cover this in the weekly update video, this is the active asset managers, which is one part of the previous chart. Currently, we're getting a little topsy right now. We're at 85.4, and even though these are active asset managers, they're still human beings, and they use emotions, and as the market's been going up, they have a real fear of being left behind, so they're typically jumping in. When we get to a reading of 80 or above, that's when we start to get extreme positive. Now, it could still go higher than this, so we'll want to see if this ends up turning down, and this could be adding a little bit to the negativity that we're seeing in the market when we say that the market has been overextended to the upside. Another look at this same chart in blue is the Active Asset Manager Exposure Index, and the yellow line is the S&P 500, and it just says at the top, institutional investors haven't been this long in almost a year. We're seeing a real positivity to the market, at least when this chart was created. We have since fallen back from those higher levels, but it's really catching a lot of people by surprise since everybody thought at the beginning of 2023 the market would go down. Here's another sentiment reading that is starting to turn negative. This is put out by Morgan Stanley, where we see a little bit of a red tick right here, and we're up at the upper end of this band. When we get to this high of a reading, that often marks an overbought condition and is due for some kind of a reversal. This is just some sentiment going back. It's called the War on Inequality, and this is just trying to compare the 2010s with the 2020s. I don't know, if you read through this and look at it and how things supposedly had changed, I don't know if you would agree with all of this or not. I won't read through all of these, but if you want to, just go ahead and pause this and see if you think you agree with how the thinking has shifted. Looking at the economy, this is the Atlanta Fed GDP Now estimate for what GDP will do, and here's the range. That's this gray area where you have the top 10 and top bottom forecasts, a little bit under 1% down to about a minus 1.5%. And coming up pretty soon, I have the Atlanta GDP Now estimate. Here's Goldman Sachs' prediction. They're not suggesting that we will go into a recession. In fact, they don't see the GDP even going negative for one quarter, let alone 2 quarters. Their forecast is that in the first quarter of 2023, we'll be up, not very much, but at least up 0.3%. And then after that, we will continue to see positive GDP. These black diamonds are the consensus. And so Goldman Sachs is a little bit different than what other folks are predicting will happen. Here's the GDP Now forecast showing that for the first quarter of 2023, they see GDP at 2.1592%, and for the fourth quarter, they also see it well up over 3%. Here's another measurement tool from the St. Louis Fed. They're not as optimistic, but they still have GDP being positive in the fourth quarter as well as in the first quarter of 2023. There's been some debate back and forth whether we're going to go into a recession or we're not, or have we already been in one? Are we in one now? Well, one of the things that we need to look at is a thing called the MBER. This is the body that officially defines whether we're in a recession or not. And if you look at this chart, a lot of the areas that are supposed to show a lot of weakness around the time of a recession are just not really showing up right now. But yet we have a lot of economic reports that are suggesting that the economy is really slowing down. This is also being plagued by the employment situation, which is still really strong overall. And that's kind of the tug-of-war that's going back and forth. The Fed is more likely to continue raising rates as long as the employment situation stays strong. This next chart just compares cyclicals and defensives. Cyclicals go up and down with the economy, where defensives tend to perform better when the economy is weaker. According to this chart, as of February 2nd, they're suggesting that a soft landing will come, which is where the Fed gets done raising their interest rates without throwing the economy into a recession. One thing that is getting a little bit tighter are the standards for credit card loans, and this just shows that banks are starting to increase their tightening standards. This often happens before a recession. Looking at inflation, this is the Inflation Now casting, which is freely available online, and I'll be starting to include that in the daily videos as well as the weekly videos. I did include this in a video that I posted over the weekend. We have CPI coming out on Tuesday, and that's going to be the real big one. Then we have retail sales and PPI coming out later in the week. This upcoming week is going to be really influential as to where inflation is at. This chart is adjusted each day, and currently they're predicting a slight tick up in CPI inflation as well as the core inflation. The orange line is PCE inflation, and then the green line is core PCE inflation. This chart just shows inflation-adjusted S&P 500 12 months before and 18 months after inflation peaks. There is a prevailing thought that inflation has already topped out and it's starting to come back down. One of the concerns of the Fed is that inflation might start to go back up. Assuming that does not happen and we've already topped out with inflation, they suggest that we topped out in June of 2022, and then 7 months later, this is when the market starts to take off after that. The blue line is the S&P 500 in the current inflation cycle, so it hasn't been finished as of yet, and it's just predicting that we could still go up from here and end the year on a positive note. Looking at employment, this is the yield curve and economic cycle indicators. The black line is the 10-year yield curve, which is inverted right now, and the unemployment rate. The unemployment rate is still very low, but there's other research to suggest that the unemployment rate hits its low right before a recession starts. On the other hand, it's hard to really justify the Fed stop raising their interest rates with the unemployment rate so low. Looking at earnings and valuation, this first chart is an updated version of the FANG index. Well, they changed it over to FANG. Facebook changed their name to Meta. But this includes Facebook, Amazon, Apple, Microsoft, Google, which is also Alphabet. And even though earnings have been coming down, and that's why we're seeing these stocks under a lot of pressure, they're still a lot higher than what the S&P earnings have been. And this uses the 12-month trailing earnings per share. This chart takes the 2023 consensus that earnings per share is falling off a cliff. It's down 10% since the June 2022 peak. This blue line is showing where earnings have been falling. The orange line is earnings if you take out COVID and the global financial crisis. The lighter blue line is the historical average, and we pretty much have been going in line with what has happened on an average basis. If we stick to that same pattern, earnings per share will continue to drop even into early 2024. This chart takes the forward earnings per share growth, showing that it's now negative for just the 5th time since 2000. History shows price downside is in front of us, not behind us. So this is suggesting that these headwinds of earnings coming down could really have an impact on the market. The yellow line is the S&P 500 forward earnings per share on a year-over-year basis. The blue line is the S&P 500. As this is going down, this could really produce some headwinds for stocks. This chart says that the S&P's forward multiple is several turns rich based on the current real rate backdrop. As yields have been bouncing back up, we're also seeing the forward ratio starting to bounce back up as well, but it's still pretty far away from the 10-year yield. These lines tend to not get very far apart from each other, and there's quite a spread between the two currently. So are earnings going to go up, or is the S&P going to come down? This chart just says analysts no longer forecast record margins, but see strengthening margins from here. The dark blue areas are reports that have already been released. The yellow area are forecasts looking forward, and these are the quarterly net margins when you take out financials, going all the way back to 2012. This chart is the S&P 500 next 12 months earnings per share against the total return level. The blue line is the S&P 500 and the yellow line is the total return. They're pretty much in line with each other right now. If the earnings per share continues to drop, that could also drop the yellow line. This chart is the non-PMI leading earnings indicator, showing how earnings have been really dropping, and the actual has been following the forecasts. And this chart actually has earnings going negative. This chart shows the S&P 500 profit margin based on operating earnings and sales. Even though it's been coming down and it's declining even a little bit less, it's still pretty high overall. And we're reading above 11% at 11.2%. This chart shows the deviations of earnings either above or below the long-term growth trend. They're calling this the everything bubble because there was no good place to get into in 2022. Everything was going down except for the dollar and energy. We're still looking pretty toppy right now with the line being red, although it is coming down. This chart just says this is the first negative year-over-year earnings per share growth quarter since the COVID recession, which was not all that long ago. The growth had been coming down and now it's finally switched over to negative. Looking at equity flows, this is just suggesting that people are having more conviction to get back into stocks. We have the equity flows in light blue and then the 4-week moving average in dark blue, and this has been increasing and is positive. This shows cumulative flows into equity by regions. Most folks still have a tendency to get into the U.S. market, followed by emerging markets, which seem to be coming back into favor. Europe is the lighter blue line, and the darker lighter blue line is Asia. This chart shows the first tech inflow in 11 weeks, so we're seeing a little bit of interest coming back into the tech sector. The black line on this chart is where we're at right now. These are the first quarter revisions during earnings season, and they have been decreasing as the revisions are coming out, and that could really put some pressure on stocks. These other colored lines just compare it to other years. This chart just shows different philosophies of investing. Discretionary means that you can pick and choose what you see as opportunities in the market, where systematic strategies just say, no, I'm going to stick with this system no matter how I feel or what other opportunities may be presented. We're seeing a bit of a tick up with the green line. That's discretionary investors, and the systematic strategies are also seeing a bit of improvement. They're still below zero overall with their equity positioning. The insider transaction ratio, after giving us a really high reading, which is bearish, it's been coming down and now it's starting to tick back up. So we're well off of the bearish reading, but we're not all the way down to the bullish reading, at least yet. This chart shows the current valuation relative to the long-term average. The one that we focus on the most is over here on the left. This is the S&P 500. The current is at a PE ratio of 18, where the average is 15.5. Suggesting that the S&P 500 is still expensive on a historical basis. This chart shows how valuations are already elevated against history despite higher real rates as of February 2nd. The light blue line is the 10-year yield, which is inverted. It had been really going up and now has been coming back down only to start spiking back up. The dark blue line is the forward PE ratio for the S&P 500. It had been going up as the market had been going up, but recently we're seeing some weakness. Based on this chart, we're about at 18.5 PE ratio. FedWatch consensus says the Fed hikes 25 basis points in March and then 200 basis point cuts. Now this is always going to change, and every day a new scenario comes out. So they think in June of 2023 we'll be at 4.88%. That'll be the terminal rate, and then we'll start to come down. And by December of 2024, we'll be under 3% at 2.95%. This shows how the Fed funds rate has been rising and going pretty much hand in hand with the 2-year yield. The Daily Shot is predicting that we will hit a terminal rate at 5.15%. That will be the point at which the Fed can stop raising interest rates. Before we had this really strong employment report the first Friday in February, Bank of America was suggesting that the Fed funds rate will be cut much quicker and go down to 2.9%. After we had that report, they've revised that to a slower tapering. This is a historical chart just showing what the Fed has done historically when they've raised and lowered interest rates. You may want to pause this and look at this. I won't take the time to go through it. I could spend hours talking about each one of these events. Looking at the S&P 500 and stocks, this chart says the U.S. market's outperformance is almost entirely due to Web 2.0. That's things like social media, video conferencing, TikTok, and a lot of the newer technology that's really come into the market. And that has really been fueling a lot of the optimism, especially in the tech sector. Here's the chart currently with the S&P 500. If you take out Amazon and Netflix, how the market would have performed worse. And then looking at Europe, if you take out their whole tech sector, how that would have even performed not as well as the U.S. market. We're just underneath an overbought reading based on this chart. When we're at 80 or above, that's considered to be overbought. We've been coming down. We're at 79.5. The black line is the S&P 500. This is a Morgan Stanley chart just showing how the market's really been having a lot of trouble going back up. We're hitting resistance based on this red trend line. I draw my trend lines a lot different than this. I guess you can draw a line to fit whatever you would like. This chart suggests that the latter half of February is one of the weakest times of the year. So as we come into the middle of February, we'll be looking at more of a downward bias. This chart is the U.S. cycle indicator. When we have orange, that is expanding. When it's red, that's a downturn. When it's green, that's repairing, and blue is a recovery. Notice how we've been really expanding up until the all-time highs, and now we've been coming down to a downturn in the cycle indicator. Share buybacks are still quite high. This is as of February 1st. A lot of companies are deciding to buy back their own stock. This could help prop up stock prices. I've even heard some talk saying that that is the real reason for the run-up that we've seen in 2023. It's not that the fundamentals have really changed. It's that companies are buying back their own stock and everybody's getting involved with that and thinking that the market is really shifting to a more bullish stance. You can also say that we're getting into a more positive seasonality. And there are some real technical things longer term that have developed that are also positive. So take your pick as to what you choose. Looking at emerging markets, we saw a lot of money going into that. Well, now it's starting to roll over slightly. This chart just says we're in the middle of the best 6 months of a 4-year presidential cycle where the average return is 14.8%. So far in 2022, when this was prepared, we were up 7.5%. Here are some attempts at producing a price target. If we're in a bullish scenario and we have earnings of $251 per share with a multiple of 16.7, that would pump us up to 4,200. The base case would have us down at 3,900 and the bear case would have us dropping to 3,500. Currently, the S&P 500 is just under 4,100 in the 4090 range, where this chart has it at 4071. This chart tries to show the average S&P 500 return before and during bear markets. If we end up hitting a recession, this is likely a prediction of how the S&P will behave. If there's no recession, the market will have a chance of going much higher. This green area is the 10% to 90% percentile. This chart by Bank of America shows how liquidity has been declining, which could produce some headwinds for stocks. This chart shows the global risk demand index, and it's getting a pretty high reading, suggesting that we may be overextended to the upside. Bonds and interest rates. As rates are coming down, that is considered to be easier financial conditions. This is the MOVE index, which I do show in the weekly video, how we topped out in September of 2022, and we've been coming back down as far as volatility in bonds. And since this is like the VIX, when it's high, it's time to buy. When it's low, it's time to go, is the general rule of thumb. Thank you. I hope you found this useful. This does go outside of the realm of the charts that I usually produce. So I have to kind of figure out what is the logic going into each chart. Well, the charts that I use, I know the logic because I built them myself and I understand what each chart is trying to say. I still think it's worth our time to go through some of these charts just to get some extra insight into the market. But that's why I pulled this out and made it a separate video, because it was tripping up my charts with these charts, and it was just making it really clumsy. And I will talk to you in the next video.